Welcome back to the Market Stalkers channel. I'm Dee and I've been trading futures professionally for about 10 years now. Today I'll talk about some misuse of a risk management strategy that is widely being advised online. The whole nonsense about risking 1 to 2% per trade. 1% for day trading? That's a massive amount of risk. And if we're talking online prop trading evaluations, anytime I hear the 1% rule, most of you are actually talking about the nominal value of the evaluation rather than the actual initial drawdown that you're given, which is typically on a 50K challenge, which is the most common one, like $2,500? So that's the first misconception, that using 1 to 2% per trade is somehow a conservative way to manage risk. It isn't! It is a very, very, very aggressive way to trade. Maybe if you're like a medium-term swing trader and you're doing only like 2 or 3 trades per month, yeah, that's fine. But not for day trading. And why do I say that? Well, because as intraday traders, we usually make multiple trades per day. I'm considered like a low frequency intraday trader. Even I make anywhere from like 2 to 5 trades per day. Okay? And some of you might do the same, but then others might make 9 or 10 trades per day, 20 trades per day. You know, it all depends on your style, right? Before I go on, usually more trades for most people does not equal more money, so keep that in mind. Some of my best days are when I've only done 2 trades and I ended up with like 4 R multiples on the day, meaning that I made 4 times the amount of what I risked. But let's say that you're only doing 2 trades per day at 1% risk per trade, and it doesn't go well, so you fuck up the entire month. It happens, right? Worst case scenario, you get yourself into a drawdown, you cannot mentally recover from the loss, and you get yourself into an extended period of losses. So how long do you have trading like that before you have blown the entire account? 1% risk per trade, 2 trades per day. 50 days. That's about 2 months before your trading career ends. And if you're using 2% risk per trade, you've got about a month before you blow it. Does that sound like good risk management to you? No, it doesn't.
Because it isn't.
No one who's a professional trader will ever use like 1% per trade of the entire trading capital. Why? Because that's how you blow up. Doesn't matter how good your strategy is. Everyone at some point will experience a drawdown. So you need to be able to weather that drawdown. Many of my viewers are now looking to scale up their capital by going to some of these online trading firms that are an excellent way to protect your own savings because you don't have to fund yourself and you offset the risk to them, right? It's always a good thing. But if you attempt to use this like idea of 1% per trade on a 50K challenge, that means that you'll be risking $500 per trade. And the industry standard right now for a 50K challenge is to only offer either $2,000 up to $2,500 of maximum initial risk. So $500 per trade, you lose 4 trades on the bounce, never mind a month, you're looking at 4 trades before you have to reset the challenge. Why? Because you didn't manage your risk correctly, because you believe some buffoons online who are like, oh yeah, just risk 1% per trade.
That's very conservative.
That is not conservative, okay? Let's just stop with this nonsense, how using 1% per trade is anything but aggressive. So instead of using 1% per trade, why don't you try using 0.1%? That means on a 50K account, whether it's a challenge or your own money, you'll only be risking up to $50 per trade. Up to. Not over, but up to. So I actually start 50K challenges using $35 per trade. That gives you time to mentally adjust to this new high pressure situation and the drawdown that you will experience once you get funded. Everybody goes through that. Whenever you start trading with higher stakes and actual skin in the game, where there's no reset button, like this is it, you will always go through a dip in performance. There's no doubt about that. Don't think that you're like 1 in a million that's not going to happen. It's going to happen. No one avoids this. So why not plan for that and be smarter than the average bear? So size down so you don't do too much damage to the account during your adjustment period. And you will adjust. You will adjust. We're humans. We're very adaptive. It's one of our highest strengths. But I want you to avoid the psychological trauma of getting funded, then blowing up in like 1 week. And if this is what happened to you, if you got funded, but you lost the trading account, you may want to look at this video.